Opportunity cost and policy decisions. Welcome to our exploration of the tools used in economic policy evaluation. We begin with the concept of opportunity cost, a fundamental principle in economics. Opportunity cost represents the value of the next best alternative foregone when a decision is made. In public policy, this means that allocating resources to one project inherently means not allocating them to another potentially beneficial project. For example, if a government decides to invest heavily in defense, the opportunity cost might be reduced funding for education or healthcare. Understanding these trade-offs is crucial for informed policy making. Quantifying opportunity costs in policy. Quantifying opportunity costs involves assessing the benefits of the foregone alternatives. This can be challenging, especially when dealing with non-monetary benefits like environmental preservation or social well-being. Tools such as cost-benefit analysis and shadow pricing are employed to estimate these costs. For instance, when evaluating a new infrastructure project, policymakers must consider not only the financial costs, but also the environmental impact and the potential displacement of communities. By systematically analyzing these factors, policymakers can make more balanced and equitable decisions. Economic surplus and policy analysis. Moving on to economic surplus, which encompasses both consumer and producer surplus. Consumer surplus is the difference between what consumers are willing to pay and what they actually pay. Producer surplus is the difference between the market price and the minimum price producers are willing to accept. In policy analysis, maximizing total economic surplus is often a goal, as it indicates efficient resource allocation. For example, removing trade barriers can increase consumer surplus by lowering prices, but it may reduce producer surplus in protected industries. Understanding these dynamics helps in crafting policies that aim for overall welfare improvement. Welfare analysis and public policy. Welfare analysis delves deeper into how policies affect the well-being of different societal groups. It involves assessing changes in consumer and producer surplus due to policy interventions. For instance, implementing a subsidy for renewable energy can increase producer surplus for green energy companies and consumer surplus through lower energy prices. However, it may also lead to increased taxes or reduced funding for other programs. Welfare analysis helps in evaluating whether the net benefits of a policy justify its costs. Understanding externalities in economics. Externalities are costs or benefits of economic activities that are not reflected in market prices. Negative externalities, like pollution, impose costs on third parties, while positive externalities, like education, provide benefits beyond the individual. For example, a factory emitting pollutants affects the health of nearby residents, a cost not borne by the factory. Recognizing externalities is essential for policies aimed at correcting market failures. Market failures and policy responses. Market failures occur when free markets fail to allocate resources efficiently, often due to externalities, public goods, or information asymmetries. Government interventions, such as regulations, taxes, or subsidies, are tools to correct these failures. For instance, imposing a carbon tax internalizes the environmental cost of emissions, encouraging firms to reduce their carbon footprint. Effective policy responses require careful analysis to avoid unintended consequences and ensure that interventions lead to improved social welfare. Taxation as an economic tool. Taxation serves multiple purposes: generating revenue, redistributing income, and correcting market failures. Taxes can influence behavior. For example, higher taxes on tobacco to reduce smoking rates. Progressive taxation, where higher incomes are taxed at higher rates, is used to address income inequality. However, excessive taxation can discourage investment and work effort. Thus, designing tax policies requires balancing revenue needs with economic incentives. Taxation and incentive structures. The structure of taxes significantly impacts economic behavior. For instance, offering tax credits for research and development encourages firms to invest in innovation. Conversely, high marginal tax rates may deter additional work or investment. Policymakers must consider these incentive effects to design tax systems that promote desired economic activities without creating undue burdens. Subsidies and transfer payments. Subsidies and transfer payments are tools for promoting specific economic activities and supporting vulnerable populations. Subsidies can lower the cost of goods, making them more accessible, while transfer payments like unemployment benefits provide financial support during job loss. While these tools can enhance social welfare, they must be carefully targeted to avoid inefficiencies and ensure that they reach intended beneficiaries. Public goods in policy context. Public goods are non-excludable and non-rivalrous, meaning one person's consumption doesn't reduce availability for others, and it's difficult to prevent anyone from using them. Examples include national defense and public parks. Because markets may underprovide these goods, government provision is often necessary. Funding public goods typically involves taxation, and determining the optimal level of provision requires assessing societal needs and preferences. Managing common resources. Common resources like fisheries or clean air are rivalrous but non-excludable, leading to overuse, a phenomenon known as the tragedy of the commons. Without regulation, individuals may exploit these resources, leading to depletion. Policies such as quotas, permits, or community management can help sustain common resources for future generations. Effective management balances individual use with collective sustainability. Efficiency versus equity in policy design. Policymakers often face a trade-off between efficiency, maximizing total output, and equity, fair distribution of resources. For example, a policy that boosts economic growth may disproportionately benefit the wealthy, raising equity concerns. Conversely, redistributive policies may reduce incentives for productivity. Striking a balance requires careful consideration of societal values and the potential impacts of policy choices. Distributional impact assessment. Distributional impact assessment evaluates how policies affect different population groups. This analysis helps identify whether a policy disproportionately benefits or harms certain demographics, such as low-income households or minorities. Incorporating distributional assessments ensures that policies promote inclusive growth and social justice. Marginal cost-benefit analysis. Marginal cost-benefit analysis, MCBA, compares the additional benefits and costs of a policy change. A policy is considered efficient if the marginal benefit exceeds the marginal cost. For example, expanding a public transportation system should proceed if the added benefits to commuters outweigh the costs of expansion. MCBA aids in determining the optimal scale and scope of policy interventions. Applying MCBA in practice. Applying MCBA involves quantifying benefits and costs, which can be challenging for non-market impacts like environmental quality or public health. Techniques such as contingent valuation or revealed preferences help estimate these values. Policymakers use MCBA to prioritize projects, ensuring that limited resources are allocated to initiatives with the highest net benefits. Fiscal policy and economic management. Fiscal policy involves government spending and taxation to influence economic activity. During recessions, expansionary fiscal policy, like increased spending or tax cuts, stimulates demand. Conversely, contractionary policy can cool an overheating economy. Fiscal policy also addresses structural issues, such as infrastructure development or education funding, shaping long-term economic growth. Practical use and limits of fiscal policy. While fiscal policy is a powerful tool, it has limitations. Implementation lags can delay effects, and political considerations may hinder timely action. Additionally, excessive government borrowing can lead to debt sustainability concerns. Therefore, fiscal policy should be used judiciously, complemented by sound monetary policy and structural reforms.